All right, so Raj says, I am a blueprint owner. That is the full course on our preferred structure for the married put limited risk position with the now sort of 13 different income methods we use to lower the initial at risk, generate income, potentially bulletproof the trading. Says, I'm a blueprint owner and I've recently started using the married puts in my trading, the radioactive profit machine RPMs. It's really great. I really like how risk is controlled in the trading system. However, I feel that through some of the real and paper trades, I am giving away a lot of gain in the stock since protective put is reducing in value, albeit not dollar for dollar with respect to the stock. Generally, I've seen at the start to open the stock goes up, my actual profit is reduced by 30%. It depends on your structure. Raj, mine is closer to only about 50 to 55%, but we'll talk about that in a moment compared to stock alone. Another thing is I feel the put needs to be rolled up as stock keeps moving up in order not to allow it to go out of the money. Not necessarily, that's a choice. That's a choice you can make on the position to do or not to do. It helps with the risk, but it is going to take away the upside. That's income method number 4 in the blueprint, probably my favorite and most used one in the Fusion portfolio. These are my observations or understanding. Can you please let me know if they are in the right direction and I'm not going off in the weeds? Also would love to hear your thoughts or any pointers, other content regarding RPM profit versus stock alone profit. Thank you so much for the lots of awesome education. Okay, Raj, well, you're welcome, but let's try and get some other awesome education under our belts. We'll start from the beginning, and then we're going to go back, and then we're going to go forward. Let's just go into the search. What we're talking about here is our preferred married put structure. This is the default search we prefer to use. 95%, I'd say, maybe more, of the trades that we post in the Fusion portfolio radioactive trading, Ernie and myself come directly from this search list. Ernie just opened Elf Beauty recently. I'm trying to think of some of the other ones that are there that he might have opened. We can go to the second page, but we'll just take a look at the Fusion portfolio in a minute. A question comes in, and this is not related to yours, Raj, but we're going to talk about it briefly. A question does come in and says, what delta to use for the put? We don't use delta in our search. You absolutely can. It's there in the patented search tool for you to use if you want to search by a specific delta. But by structuring the trade of what we look for with the controlled risk in place, not going too deep in the money, because there is such a thing as going too deep in the money, and limiting your potential for profit too much. Okay? So, but without even using delta, just on the first page, the first 15 results, the deltas here range 0.59 negative on the put, negative put delta, which means for every dollar the stock goes up, I'll lose about 59 cents on the position. So I still should be making 41% to start with of what I expected. And the lowest we have, I thought I saw 0.43, but there it is. Yeah, 0.43. So that means for every dollar the stock goes up, I should still expect to make 57 cents for every dollar. Not 30 cents. But fluctuations in bid-ask spread, fluctuations in implied volatility can do that. Now, I'm going to cheat, but I don't really call it cheating. We're just going to look at a real-world example. And we might prove to ourselves that Raj is correct in this portion. But, you know, a trade that I know, a trade that I'm in, just made an adjustment on today, is Arista Networks. It had a pullback recently, but has also had a strong run within the last 10 days or so. So what do I mean by I'm going to cheat? Well, we're going to take a look at the chart. The stock's went as high as 144, came down as low as 134, and is now back above 140. I could have told you this was going to go up to about 141 or 142 today because this morning I sold the 142 call for next week. So naturally, the stock's going to start approaching that and gap through it because I sold that call. But that's okay. The position is bulletproof, and it will stand to make it close to a 9% return if I'm assigned at 142 next week. Let's go here. I'm going to go to the lower day, the 22nd, February 22nd, when the stock opened. Well, it closed at around 135. So we're going to use that. Let's go to the chain. Yep, 205. That's what I probably would have selected. We're just going to look at the puts. There we go. Now the stock's trading at 135.21. The 140 would have given me an 8.1% risk. The time value is the risk on the trade. And the 145 would be 6.4. Now the 140 is at 1570 midpoint. Might not get the midpoint. We're just going to use that Raj for our example, this query. And our 145, of course, is at 1840. Now, 135.21 is the stock price. I am going to need that as well. Let's enter our 2 married puts into the portfolio. And I don't want to put it here. Let's add it to the long calls on Annette, shall we? But let's enter our married puts. Do Annette. Do 100 shares. $135.21. We're going to purchase on that same day, the September 1st, the 140 put. Date really isn't important, but let's just keep things even. And our price on that date was $15.70. All right, so let's go ahead and submit that. And before we look at the numbers, let's enter our other married put trade with the 145 deeper in the money put that should have had a risk of about 6.4%, I think is what I said. 135.21. September 145, and that price was 1840. No, date, okay, let's be consistent. Fantastic. Now, in both cases here, we do see an issue that you had brought up. That's very interesting. So the stock has moved up 4% from where we got in at 135.21. I'd expect to be about a 1.8% return based on the deltas that we saw on the chain. That's only showing a 1.3% return at the midpoint close. So that's pretty close to what you mentioned of only seeing 30%. In general, though, that's not what I typically see. And that's just in the first few movements. The trick with Annette, it's a 33% move. Now the other one here, 4% move in 1.5. So that's probably the 40% close to it, 37.5% as well. This could be related to the fact that the earnings for Annette was during that week. I think it was on the 26th or the 27th. So we would have paid into a higher implied volatility. Then after the implied volatility, the earnings would have decayed out. I'm sorry, the implied volatility would have pulled out and decayed. But going back to the chain very quickly. Sorry about that. So our move to January, I apologize. There we go. The 1570 price, the 1840 price. And there we go. A delta of 0.454 and 0.505. So again, I would have expected, and I typically see more movement related to the delta. In other words, for that $4 the stock had moved up, or $1 the stock had moved up, I'd have only expected lost 45 cents on the put, still gaining 54, 55 in those cases. And that's usually what I tend to see. But as I mentioned, it says 5-1, so it wasn't 3-1. It was before then. I think I made a note of it in the Fusion portfolio. I don't think it was 3-1. I think it was before then when I made my last trade to Bulletproof. Oh, yeah, it was well before that. So, yeah, but I think that was part of the issue, that the earnings coming up sort of jaded this position in those cases. Now, also one thing I want to check on February 22nd. Let's just go to quotes for the VIX and February 22nd. We're at 1849 right now. $22.29. All right, so we've had a significant drop in volatility across the board, and that might be affecting the positions. Am I saying that you should only buy into a married put position when the option is in the lower range of its implied volatility range. Not specifically, but is something I typically will look for. And on February 22nd, what was my implied volatility? 0.3761. Okay, so this is right in the middle, essentially, of 0.3499 to 0.4096, about 50% implied vol, 44 and 30. So these aren't too bad. But current for the September 140 and 145, 0.3588 and 0.3554. So they're dropping. Oh, I'm sorry, I looked at the wrong ones. 0.3622 and 0.3588. So they have dropped, but not that much. But that drop is significant to what the expectation of the price would be if we did it and kept the same volatility. Okay. Now, the second portion of your question. So, yeah, I don't have one that I haven't made an adjustment to, but go here. So your point's valid. It's just not something that I typically see. Ignore that one that's expired. Yeah, see this position here, the actual ANET position I'm in is up 16.8%, and I'm about at a 10% return right now on the position, Raj. After income methods have been done, and yes, after I've adjusted the position using income method number 4, I think I actually used a 9 at one point and then did a 4 again, if I'm not mistaken. I did a 3 in this position as well, too, right before that earnings date. So, you know, I'm still making close, it's about a 9.8% return. Well, the stock up 16%, 16.8, let's be honest with that. So I'm still at about 58.5, 58.7% gain, close to 60 in the underlying security. And that's what you expect with the position. But of course, as you know, let's go back to that ANET long calls. As the stock continues to move up, your delta is going to continue to change. And that's why you start to see the curved red line and the blue line start getting closer and closer together as you go further and further up in price. Because the delta I started off with, even if volatility is dropping of say this is the 145. So the 0.45 negative delta should be dropping now to 0.42 and then down to 0.41 and then down to 0.35. So that for every dollar the stock is gaining, I'm seeing less decline on the put against it, more profit with the one delta stock compared to that position. We typically expect to see 50 to 60%. That normally happens. When that doesn't happen, it's typically due to a shift in implied volatility, passing through an earnings event, or the fact that volatility across the market recently, as we saw on February 22nd, was near a recent high of around 22, 22.5, 22.6. And now we're down to 18.49. So that's sucking some of the premium out, even though the stocks are moving up. And that's something that can affect this to that. Later on, you and I will get together. Send me an email of some of the recent new Married puts you opened. I'll be able to go back in time, take a look at the implied volatility range, or you can do it yourself using the research tool for your put options as you're tracking them in PowerOptions. And whether you're on the option chain, whether you're tracking into the portfolio here on the profit and loss chart, we can go to the option research tool. And I can see historically what the implied volatility was. And so, yeah, back in, let's see, back in February 11th, almost at 0.4. And, you know, still here we're at 0.38. And right now we're at 0.36. But the 22nd we've gotten in, it's not too bad. It's a 0.37. But here recently up at 0.38, is that even a big enough shift to lower the price between 0.38 and 0.36? Now let's take a look. Down below, 0.36, the expected value of our stock on the halfway point. But let's go closer in time. Let's go to the 7th. So with a volatility of 0.36, we had an initial cost basis of 1840. The expected value 1494, so a loss of 346 with only a gain of 547 in the stock, or 200. So that's about 35%. Now we go back up to 0.38. Now we're closer to the 2-to-1 we're expecting, aren't we? Just that subtle move of 0.02 of a point from 0.36 to 0.38. And we have a gain of 282, which is about 50% of the decline that we see. It comes into play, but it's going to shift out of your control. The important part is that I'm only risking 5.6% on this trade, even if the stock falls out of bed. That's the important part to start with. This was the deeper in the money one. But you can see here using that calculate feature what even just 0.02 of a point change will do to affect the position with what your expected profit would be. And we saw that had dropped down at one point to 0.35. There's your 30%. Actually, a little bit worse than that. It's about 25%, Raj, isn't it? So those are one of the things you watch out for. How can you avoid it? One of the things I like to do, let's just go back to the Married Put search. We mention this from time to time in webinars. It's not a default criteria, but a lot of times I'll look for positions where the percent implied volatility range is less than 65 or less than 60%. That means where is the options implied volatility now compared to where it has been over the life of the option. I don't want to go into one that's at a 90% or at 80 or 75%, see it drop down to its lower range, and I'm in the situation you're talking about. The reason I did this is years ago, many, many years ago, one of the married puts I had was on a pipeline, LLC pipeline, or El Paso pipeline, LLC. And I didn't realize this. The trade looked really good. It was a married put, standard time frame, 5.5, 5.6% risk, only 1 or 2 strikes in the money, not too deep at all. And I didn't do my full research. I didn't go back in time enough to the articles to see that they were trying to do a land lease and get approved for it in Brazil for a large field for drilling. It didn't come out while I was in the trade. After 3 weeks in the trade, they got declined for that land lease. The Brazilian government said, no, we don't want you here. And the stock didn't move too much. If it passed, it probably would have jumped 10 to 15%, but it didn't move too much. It moved down maybe 2 or 3%. But all of a sudden, my put option time premium was cut in half. Now it made it very difficult to do any adjustments with the put, because without the stock even moving, I had lost half the time value I paid into that. Half of the risk had already just disappeared out of nowhere because the implied volatility collapsed because everyone was waiting for that moment, just as they do with an FDA approval on a drug stock, phase 2 or phase 3. You see that implied volatility just disappear after the announcement. And that's what happened to El Paso Pipeline. The position could only lose 5.6%, but that advantage that we talk about with rolling the put up, being able to roll the put down or roll the put closer in time, the different 4 ways we can adjust the put option as a second working asset was now all gone to me. It was much more difficult to get that position to a profitable level. I did, but it took longer than it should have because of that effect. So that's what I always do now is I start with that point. Let's see, we had 47 results. We still have 46. So you won't see it change too often, but it's always a good idea to have that extra background. If you find yourself, Raj, consistently not seeing the 58 or 50%, I should say, 55 or 60% gain in the married put that you'd expect compared to the stock price. It's a flux and implied volatility and other things related to it around earnings. I'm following up on your question. Can you please let me know if they are in the right direction? I'm not going off in the weeds. No, I don't think you're going off in the weeds. I just think this little pointer might help you out a little bit further to that understanding of how the implied volatility flux, even a small move, can affect your expectations of, hey, my stock moved up 4 points. I should be at a $2 profit. I'm only at 130. What gives? Check the implied volatility. Check to see if there was a change. Check the market volatility as a whole, if it's been declining or not. You know it's going to fluctuate and it's going to come back, and sometimes it's going to work in your favor. But you may want to start checking into that at first and using the percent implied volatility range so you don't get caught in one of those positions.